Our featured guest is here on set, John Praveen, the Chief Investment Strategist at Prudential Financial. John, let's start with you. It looks like we could be getting 7 consecutive days of gains on the S&P. Okay, right now it's down, but only half a point. Not a bad end to the year, much better than the end of 2008, I would say. Where do we see next year beginning?
I think that the gains that we saw this year will continue into the next year. We had maybe about 30% gains this year. We are looking for about 20% gains, and for the S&P 500 to end 2010 around 1350.
Why such a bullish forecast, considering all the headwinds we're looking at here? Obviously, the unemployment is a problem. Housing, even though we got some relatively good news today, still in the doldrums. What do you expect to change?
Well, you did point out to a few headwinds, but there are a lot more tailwinds supporting the equity markets. First, I think that GDP growth is likely to surprise on the upside. We are looking for solid growth around 3.3%. That's probably much better than what consensus is expecting, and I think that maybe growth will surprise on the upside. That's one. Second, earnings are likely to rebound quite sharply. Between 25 and 30%, but earnings are also likely to surprise on the upside. So with GDP surprising on the upside and earnings surprising on the upside, and the economy enjoying the macro sweet spot, by which I mean solid growth, low inflation, and low interest rates. All of that make for strong tailwinds for the equity markets, for the U.S. equity markets.
And John, let me ask you first about higher taxes, about Washington legislating a lot more regulation. Although we haven't seen it yet, that's obviously factored into Mohamed El-Erian's new normal, which has become really a prevalent part of the way people think.
I think what you're talking about is possible. It comes under the realm of policy mistakes, and clearly the risk of policy mistake is there, especially from Washington in terms about higher deficits or also in terms about higher taxes. But on the other side, you have a lot of fiscal stimulus that is still out there. For example, out of the $787 billion that was legislated by the Obama administration, barely about $236 billion has been spent. $550 billion is still due to be spent, and out of which something like $400 billion is on tap for 2010. So there's a lot of fiscal stimulus. Then you have a strong contribution going to come from inventories. Inventories are at the lowest level in 60 years. The last time inventories were this low was in 1949. So just rebuilding of some inventories gives you a good amount of macro momentum back into the economy.
I mean, we did see a forecast from Morgan Stanley yesterday, 5.5%. That would obviously push up mortgage rates. That would be a problem for housing, and then the economy again.
Yes, if yields actually go to that level, it would be a bit of a problem. But I don't think that yields will go to that level. I think that yields probably will be somewhere in the 4.5% range. That's our forecast, because core inflation is still very, very low, and we'll probably see core inflation in 2010 in the 1.5% range. That should keep a lid on bond yields. Secondly, commercial banks are still buying treasuries. So they will probably reduce buying treasuries and then start lending more money. But we'll probably still see a bid from commercial banks that should also provide some support for bond yields.
What do you think, John? I mean, say we had another contraction, one quarter even, only in 2010. Is that disastrous for the markets?
It probably won't be disastrous if it is just about one quarter. But I don't think that we will get even 1 quarter of negative GDP growth. Tim talked about the headwinds in terms about high unemployment rate and consumer deleveraging. What that is going to do is that is going to make this rebound much weaker than the rebounds that we have seen. I talked about a 3.5% GDP growth for 2010. That's about half the rate that we have normally got when we had coming out of a recession. In the past, in the post-war period, whenever you had a recession as deep as the one that we have had, GDP in the first year after the recession grew by about 7%.
But we never had consumers as highly indebted as they are now. I mean, they haven't really deleveraged that much at all, have they?
Yes, but they have been deleveraging a little bit. The savings rate has gone up, and even if it goes up a little further, okay, that is going to have a negative impact upon consumer spending. Now, in the past, when we came out of a recession, consumer spending grew by almost about 4%. We are not looking for that. We are looking for about 2% consumer spending, and that is the reason why this recovery is only 3.5% as against 7%. So all of these factors are already baked into the cake. So I don't think that either the deleveraging or the high unemployment are enough to derail the recovery. They will slow the recovery, not derail. That's why we should get what I call as a Nike-shaped recovery rather than a V or a W. So no W,
swoosh.
No V,
Is it a swoosh?
A swoosh. Yes.
A swoosh. And John, I mentioned the debt here. What is your longer-term outlook? Because we are racking up some serious debt, right?
Yes, I think longer term, we will probably see bond yields rise even higher over the next couple of years because of this big budget deficits that we are having. And but one thing is that, as we come out of the recession and as the economy keeps growing, there will be some inbuilt stabilizers, and that will probably bring down the deficit to some degree. Though from a cyclical point of view, the deficit should come down to some degree. Though from a structural point of view, the deficit is probably going to be on the higher side, which will probably put some upward pressure on bond yields. So we are going to be seeing bond yields remaining high for the next couple of years.
By the way, are you concerned about when the Fed actually really starts to mop up liquidity? I mean, Tim mentioned this is only short term. Glenn Hubbard earlier saying it's more of a political move, a gesture. When do you think we're going to really see it actually happen?
I think that the mopping up of the liquidity will probably start sometime in the second quarter of next year, because I think the Fed would probably like to wait until it begins to see the peak in unemployment and unemployment actually beginning to start declining.
So it's not key to your 1350 forecast, basically? The liquidity, because a lot of people have been saying this rally is a liquidity-driven rally.
No.
Your forecast is based on the economy, based on earnings, based on a recovery.
Yes, this is not, our forecast is not based on liquidity. Our forecast is based upon GDP growth, solid GDP growth, and earnings growth. Last year was a liquidity-driven rally. This year is going to be the show-me rally.
All right. Hey, John, thanks a lot. That's all we have time for. John Praveen, thanks for joining.